Welcome to The Explainer. When two companies decide to join forces, who's really in the driver's seat? Today, we're diving into IFRS 11, the accounting rulebook that answers that very question and decides how these massive partnerships actually show up on the books. So, let's start with a really common scenario. Imagine two companies decide to build a new factory together. They're going to share the costs, the risks, and hopefully the rewards. But the big question is, how does this partnership actually get reported on their financial statements? Well, that's exactly what IFRS 11 is all about. To get to the bottom of this, we're going to follow a really clear step-by-step path. We'll start with what a joint arrangement even is, then we'll look at the absolute key ingredient, which is joint control. From there, we'll see the two different paths the accounting can take and what each one really means for the numbers.
Okay, so first things first. What exactly is a joint arrangement? To figure that out, we've got to start with the official definition.
Now that definition looks super simple, right? But it's actually incredibly precise. See, a joint arrangement isn't just any old collaboration. The one non-negotiable must-have ingredient that changes everything is that concept of joint control.
And that brings us to the first big hurdle. Because if you don't have joint control, well, the rest of the standard doesn't even apply to you. So let's break down what it is and how you spot it. Okay, that's a bit of a mouthful, but the phrase you really need to latch onto is unanimous consent. What this means is that for the really important decisions, the ones that drive the business, all the key players have to agree. No single partner can call all the shots.
So really, it just boils down to a two-part test. First, does a group of companies collectively control the thing? And second, do those big decisions require everyone in that group to give a thumbs up? If you can answer yes to both, congratulations, you've got joint control.
You know, abstract rules are one thing, but seeing how this actually plays out with some numbers makes it all click into place. Let's use a scenario that comes straight from the official IFRS guidance.
This example is perfect because it shows you why the details are so important. Party A has 50% of the votes. You'd think they're in charge, right? But look at the decision rule. You need 75% to get anything done. That means Party A is totally powerless without Party B's 30%. They have to agree. That right there is joint control between A and B. And Party C, well, they're just along for the ride.
Okay, so let's say you've passed that first test. You've confirmed you have joint control. You now arrive at a huge fork in the road, and you have to make a choice that will dictate everything about your accounting from here on out.
So what's next? You have to classify the arrangement. And this isn't just about picking a label. The accounting is completely, fundamentally different for each type, so getting this right is absolutely critical.
So the two choices are a joint operation or a joint venture. Here's the difference in a nutshell. In a joint operation, you think about your direct share of every single asset and every single liability. But in a joint venture, you take a step back and just think about your right to the final net result, the assets minus the liabilities.
And this table really gets to the heart of it. It all boils down to your specific rights and obligations. You have to ask, are we on the hook for specific debts? Do we have a right to that specific piece of machinery? If the answer is yes, it's almost certainly a joint operation. But if the whole thing is set up in a separate company that holds all those assets and debts, then you're probably looking at a joint venture.
So, let's go down that first path, the joint operation. What does being a joint operator actually mean for a company's financial statements?
The logic here is pretty direct. As a joint operator, you recognize your proportional slice of everything. Your share of the factory, your share of the bank loan, your share of the sales, your share of the utility bills. All of these things go directly line by line onto your own balance sheet and income statement.
Now let's completely switch gears and check out the second path. Accounting for a joint venture is a totally different ballgame.
With this one, instead of recording a piece of every asset and liability, the company just recognizes its entire interest as one single line item on its balance sheet, investment in joint venture. Then it uses something called the equity method, which is really just a way to adjust that single investment line up or down each year to reflect your share of the venture's profits or losses.
And this quote really brings us full circle, doesn't it? It all comes back to this one core principle. The accounting isn't about what you call the partnership. It's about the real underlying economic substance of your rights and your responsibilities. At this point, you might be thinking, this is all just technical accounting stuff. But honestly, the choice between classifying as a joint operation versus a joint venture has a massive impact on how investors, banks, and just about everyone else sees a company's financial health.
Let's just visualize it for a second.
With a joint operation, you're adding your share of all the assets and all the liabilities to your balance sheet. This makes the company look a lot bigger for sure, but it also shows a lot more debt. And this can dramatically change really important financial ratios that analysts are watching like a hawk.
And all of this leads to a final, pretty critical question. When a company bundles everything into that one single investment in joint venture line, does that create a cleaner, simpler picture? Or does it risk hiding the company's true financial exposure from view? It's a debate that gets right to the very heart of transparent financial reporting.